Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. In some ways, this week's commentary feels like a duplicate of the one I made 3 weeks ago. I'll shortly explain what I mean by this, but first I wish to set out the market's overall picture, which I'm afraid will take some time as there is no simple solution here for what is a very complex problem. The bear channel, currently at 512 to 586, for the February to June action, which is highlighted on my daily chart in bright red, had been the most significant pattern this year. Now, 5 weeks ago, the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by not only closing over the short medium moving average, currently at 660, but also above the 50% absolute Fibonacci line at 682, and then the slowly dipping but now flatlining medium moving average, currently 671. The move up over the 50% absolute Fibonacci line was intrinsically important, but it was also important in another sense, as it was the gateway to the congestion band from March and April between about 682 to 721, within which sit the January 2021 high at 693 and the old October 2013 high at 721. 3 weeks ago, prices followed on even higher by utilizing the medium moving average as a base for an attempt up into another congestion band dating from December last year through to February this year, between about the March 2014 high at 725 up to the lesser Fibonacci line at 799, containing within it the January 2022 low at 739 and the May 2014 high at 744. The market made up into this congestion band, pushing up as far as over the March 2014 high, and even over the one piece of resistance coming down at that time that any market would have trouble in overcoming, and that's the slowly declining long moving average, currently at 733. Prices punched through the long moving average on 2 separate occasions, but did not close over it. Okay, so this is where I reprised my discussion point from 3 weeks ago, not only to discuss it as a point, but later to bring it into this week's action. Okay, so I said 3 weeks ago, and I quote, "Whether I have named a specific level as one of the most stunningly accurate pieces of technical analysis I've done in a while, or else somebody was taking a mickey. You see, for a few weeks now I've been talking here about the bear channel highlighted in bright red that I mentioned earlier. Last week, so that is now 4 weeks ago, last week I even finessed the point further by specifically highlighting a topside level that was set at the time, and I quote, "Thus a primary target X would be in the 770 area, only a little above where we have reached, but the secondary target X1 would be a lot higher, up in the 855 area, and there is quite some congestion overhead, and one important downtrend, the March 2022 to date downtrend, that's currently at 815. This is the one based on the ultimate high of this market, but we'll have to see if the market can achieve target X first." End of quote. End of all quotes. Well, as you can see, the high in late June after this original commentary was in the 770 area, specifically at 770 and a quarter. This happened, and then the market turned around and fell away. I do not believe that to have been a coincidence. I suspect it was another technical analyst who also came to the same conclusions I did and acted upon them, or it could just be the market taking the mickey. In whichever case, I was grateful to see target X achieved and then see prices fall away, justifying it. Now, since then, prices have fallen away back below all the previous resistances that became supports. They have once again become resistances. It fell down to the significant neckline, currently at 648, of the small October 2020 to November 2020 head and shoulders top, which is highlighted in purple on my daily chart. This neckline now has a fairly wide congestion area clustered around it, formed from late April to mid-July, between about 609 to 679. This congestion lasted for about 2 weeks, supplying the market with ammunition, before we had another attempt higher this week that rallied from the neckline and the 3 out of the 4 moving averages that were in the same area, all the way up to the 770 target X area again, this time peaking at 769, before the phantom technical analyst out there, or Mickey Taker, take your pick, chose to cap it yesterday, once again, with an indecisive spinning top at the 769 level. Now, in addition to this, I started a discussion of an idea I had 4 weeks ago for the construction of a possible new large pattern. It was for a February to date and possibly even an October 2022 to date descending scallop pattern. This one seemed to have moved on along quite rapidly from its infancy, but the move up this week has provided some cognitive dissonance on this idea, both helping it and hindering it at the same time. I'll explain what I mean shortly, but first my ideas from 4 weeks ago centered on this pattern forming, and I quote, "The first level to watch and see if it develops is right around where we are, the 708 area. The second, that would be higher around the mid 780s. More on this should it develop. I just wanted to give you a heads up just in case." End of quote. I added 3 weeks ago, and I quote, "Well, the 708 level did nothing. However, the 780 area, well, that exhibited potential last week, and this." So that is 4 weeks ago and 3 weeks ago. And it would also be for the potentially large October 2022 to date action. Personally, I suspect if we haven't had the declining long moving average capping the market, then this would have been a lot harder to see. That being said, we are close, but we still have some building to take place to form this pattern, and so many things can scupper this idea before it happens. End of quote. Since then, the move up to the 770 area has finessed this topside watch level from 780 down to the 770 area. However, having this recent Twin Peaks affair has complicated the idea of a descending scallop pattern. It has not killed it off, just complicated it for me. Ideally, for a descending scallop pattern, the market needed to hesitate just the once to form a lip, if you will, which it did do in late June. Again, ideally after this hesitation and lip building, prices need to move in the direction of the ultimate pattern. Now, this move could have been both up and down, but it's important to note that a little over 3 out of 4 times, the subsequent move has been noted by data to be down. That is what I thought we started to see as we entered into July. What was needed at the start of July to see the fulfillment of such a pattern construction, and please bear in mind, this is just the completion of the construction of the pattern, not its outcome. So what was needed was to see if prices could come down to the base of the scallop. 3 weeks ago I suggested the July 2021 low at 609. However, last week's low at 622 could suffice at a pinch. This week's move up has put a spanner in the works, but I'm holding off judging this as yet until I see some more action. You see, if the next move lower or higher, and then possible, and then if you see that move, then and only then can we start laying some potential targets. Chicago corn. Back in early to mid-June, we saw a remarkable recovery that carried on into the 3rd full week of June. Prices punched up through the older congestion at 548 to 556 and at 561 to 567, like they weren't even there, along with some more recent congestion from early May between 580 and 600. This congestion, as I said 5 weeks ago, and I quote, "Apart from being recent, is also not that strong, and it would not be surprising to see a move higher towards the wide band of stratified congestion from February through to April between 610 to 640, end of quote. Now, I further added at the time, and I quote, "Beyond that comes the first big significant longer term resistance, the 50% Fibonacci line of the September to May 2023 move at 655. In between any attempt there and where we are now, I hope we can see a new pattern emerge. perhaps a skeletal descending scallop pattern, but it's too early to see right now. End of quote. In addition to the congestions, the market has also punched up through the short medium moving average, currently at 536, the medium moving average, currently 574, as well as the late February to date downtrend, currently at, well, I think it's around about the 659 area or thereabouts. All these, along with the 610 to 640 band, have slowed and eventually turned the market back down without the need of relying on the capping action of the descending long moving average further up, and that's currently at 622. Now the pullback lower at the end of June and into July has been similarly remarkable. The one key piece of market action I wanted to see happen I described 4 weeks ago thus, and I quote, "To see if we are forming a lip as part of the descending scallop pattern," and by a lip I mean the following. In case the market chooses to try and form a descending scallop pattern, it would need first to hesitate to form a lip, and then after hesitating for a while, move in the direction of the ultimate pattern. Now this move can be both up and down, but it's important to note that a little over 3 out of 4 times the subsequent move would be lower. That is what is needed to be seen in case this market does intend to form a descending scallop pattern. I have to say, if it does try to do this, then it will be one ugly looking pattern. End of quote. Okay, so we have seen the market hesitate and fall to even lower levels than back in May, and in the process form a lip. The question I left last time was, how far will this market need to fall to fully construct an ugly looking descending scallop pattern? I commented on this 3 weeks ago thus, and I quote, At the moment, the market is being held up by the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525. This is not enough, nor is the October 2021 low at 516, nor the lesser Fibonacci line at 506. Only when we may see prices down within the congestion band between 486 to 498 that contains the 2021 low at 498. Only then can we start looking at this potential descending scallop pattern as having been formed, and thereafter at potential targets for a follow-on below. End of quote. Well, prices did fall down to the congestion between 486 to 498, but in the middle of last week the market formed a pipe bottom and shot straight back up again, penetrating all the resistances once again, and seemingly finally coming to a halt at the July 2013 high at 563.5. with yesterday making a bearish dark cloud cover pattern type, as well as a possible day 2 and a 2-day tweezer top and or pipe top patterns. Looking at this action, there is no way that this could be a descending scallop pattern, no matter how much I optimize it. Prices have seemingly rested today between the descending short medium moving average below and the new 50% Fibonacci line of the June to July move overhead at 549. For the moment, I'm going to take a short step back and wait and see what new pattern will develop here. Even the monthly charts do not provide much of a clue, other than this right now looks like a monthly bullish engulfing pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.